My name is Bob McNally, and I'm founder and president of Rapidan Energy Group, a Washington, D.C. based energy market, policy, and geopolitical consulting firm. My career has been spent mainly as an energy analyst, but also did a stint in the Bush White House from 2001 to 2003, or as I call it, Enron to Iraq. And so I got a behind the scenes look at how both domestic and international energy policy and geopolitics is made and unfolds. So my lifelong interest has been the oil market. I got into it not because I liked oil, but because studying at grad school during the first Gulf War, it just became apparent to me how much oil and energy bring together not only markets, but policy and geopolitics and history. One thing I think people tend to underappreciate about oil is just how prone it is to wild oil price volatility. Now, everybody knows oil prices are always volatile. There's always cycles and things, and that's true. But over the last 20 years, we've seen oil prices swing by much more than usual over the last, say, 90 years prior to that. You just don't see oil prices quintuple as they did pretty much from 03 to 08 without a war in the Persian Gulf. And you don't see oil prices collapse from 100 to, well, it got to negative $37 a barrel at one point in 2020, but down to the 20s without a recession, and it did. And we have to ask ourselves why, because volatility for the price of oil matters for everybody, not just the oil industry. Oil is the lifeblood of modern civilization because just about every vehicle on the planet, well over 90%, runs on it. And diesel fuel, as we're all learning now, is very important for the economy. It runs our ships, it fuels our tractors, it powers it provides heat to our homes, et cetera, and so forth. It's also very important oil for petrochemicals, for our everyday goods and services we use. So oil is the lifeblood of modern civilization. We have been on recently for the last 20 years what I call space mountain volatility, not your usual it's a small world volatility, but wild volatility. We have to ask ourselves why. And I wrote a book, and to do that, I really wanted to explore it. And some folks say, well, Bob's going to start with the Arab Oil Embargo of 1973 because we know nothing possibly could have happened before then. That's archaeology that was relevant for today. But what I learned is you actually have to go before 1973 to understand why oil prices are so volatile. And when you go back to the beginning of the oil market in 1859, what you see is the oil market, it goes through long-term periods, like many decades, of relative stability and then wild instability, or what I call boom-bust oil prices. Now, why are oil prices prone to boom-bust cycles? Well, as economists would say, they have extremely low price elasticity of demand and supply in the short run, and storage is limited and costly. That's the economic jargon. But let's just back up for a second and just realize, think about oil on the demand side. Oil is a must-have commodity. You can live without movie tickets or cigars or diamonds, but you got to fill your tank if you're going to work or you're going to go see your family or you have to get to the hospital, right? So it's a must-have commodity, not a want-to-have commodity. And your consumption of oil is not going to change that much if the price moves a lot. You don't have a lot of choice. That's up or down. As you see now with $5 gasoline, folks still have to drive. They can try to drive a little less, but you're not going to immediately sell your car and walk. You're not going to immediately carpool. Think of it the other way. What if oil prices were to collapse, in half or more tomorrow? Would folks just be driving their cars in parking lots for the heck of it because it's so much fun to drive? No. So demand for consumption for oil doesn't really change much. It's not responsive to price. And then you think about the supply side of oil, finding and developing new oil fields and building oil pipelines and building oil refineries and then distribution infrastructure is extremely expensive and takes years. And once you invest that capital up front, you tend to use that infrastructure. You run it all out. Your operating costs are low. And so if the oil price goes really high, you don't have a lot of spare capacity to increase. President Biden's finding that out now. If oil prices go really low, you're not going to suddenly shut down your refinery. So when you have any commodity where supply and demand are so insensitive or sticky, or inelastic with respect to price, you get big price swings when you need to balance the market. So this was clear from the very first days of the oil market. We had wild boom bust prices. The price would soar, attract new investment. Eventually the investment would start up, the price would collapse, people would be ruined. And so Mr. Rockefeller comes along in the late 1800s, John D. Rockefeller, and says, can't have this. No, no, no. We're going to make this into the new lighting fuel. Oil was at first used for illumination. Rockefeller restored some semblance of order and reduced price volatility by monopolizing refining and integrating, doing deals with what we call midstream today, which was railroads and pipelines back then. Okay, so Mr. Rockefeller brings us from Space Mountain price volatility in the mid 1800s to normal volatility, much more smooth, much more tolerable in the late 1800s. But then we don't like Rockefeller, the progressive era. He's an evil corporate titan. And so we bust up Standard Oil in 1911. What happened? And this is very important. And if you stay with me on the history, I promise you, it's going to make sense for where we are and where we're going. Anyway, 1911, Standard Oil gets broken up under the Sherman Antitrust Act. What happens? We had the last sustained period of boom bust oil prices. And now oil graduated from just being an illumination fuel when the government could care less to being a transportation fuel, which means it was winning wars. World War I, they say, was won on oil, and it became a critical, vital economic fuel. Now government cares a lot. You know, we have calls for investigation of gouging right now. The first call for a gouging investigation was in 1920. Congress was outraged because we had our first oil price boom. But by now it's gasoline. We had gotten rid of the horses and buggies. We're getting into cars. And suddenly everyone's very concerned about the price of oil. And so with no supply manager, oil reverted to its natural wild price volatility. So then we get into the early 1930s. We had a price bust. We had too much oil, like in 2020. And in response to that, Texas, which was a major oil producing state then as now, got so frustrated that they send troops into the fields to stop the drillers from drilling, and they implemented quotas for 40 years. The irony, the supreme irony of the oil markets is while Americans love to hate OPEC and we love to hate people who control the oil market, we were OPEC. The Texas Railroad Commission, they resorted to heavy-handed quotas on drillers that would have made Mao Zedong blush at how heavy-handed it was. And they did this not because they enjoy limiting production or enjoy government officials telling private sector, business people what to do. They did it because if they don't, they learned you get wild boom bust price volatility. Okay, so Texas controls the world for 40 years. OPEC takes over for 40 after that. OPEC lost control in 2008. And that is why we've seen this wild boom bust oil prices return. We've had no effective, durable swing producer. Now, what you've seen in the past is when you have these big booms or busts, it usually forces producers to try to get together and reestablish supply control. So that's what you've seen with Saudi Arabia and Russia. They squabble, but they got together in 2016 and they agreed to work together. So far, it's like a Netflix series. Sometimes they're getting along, like now, and oil prices are relatively stable. Sometimes they're not, like 2020 and the price collapse. And so they're on again, off again. And we've had some semblance of price stability, but really we have no effective, durable swing producer. So that's in a nutshell why oil prices have been so volatile. In a way, ironically, think about it as no OPEC, no peace, no swing producer, no stability in oil prices. And that's just the way the oil market works. Okay, so let's see about where we were. And where we're going. Starting in 2014, after oil prices had been at about $100 a barrel for 3 years, prices collapsed. We entered a bust phase, right? Prices go very low, investment starts to fall. Consumers love it because gasoline was like $1, $2 a gallon. It was a lot of fun. But those bust phases last about 5 to 7 years. And this one was extended and prolonged by COVID, which crushed demand. Okay, so we've just had a prolonged, awful bust phase. Investment for oil production, refining capacity, as we see, has collapsed and is falling. But we were starting to transition last fall into a multi-year boom phase, and booms follow busts like night follows day. The seeds of a boom are sown in a bust, low investment, and you encourage demand. We stopped buying fuel-efficient cars pretty much in in 2014 because gasoline prices were so low. Okay, so last fall we were beginning to transition, I believe, into a multi-year boom cycle, and unfortunately, all oil price booms, not most, not some, not hyperbolic all, but I mean literally all end in recession. They do. And this is why folks prefer to have a swing producer stopping these price booms. But anyway, last fall, we entered a multi-year boom price cycle. It's probably going to culminate in the middle of the decade with a price spike up until the mid to high $100 range, in my view. And as all price booms do, end in recession. But then what had happened? Mr. Putin thought it would be a good idea to start the largest land war in Europe since World War II, and also pose the largest oil disruption risk since the 1970s. Russia is the world's largest oil exporter. Almost 5 million barrels a day of crude and about 3 million barrels a day of product, half of which goes to Europe. Okay. And we see now in response to his brutal invasion of Ukraine that we are going to, the United States only imported a very little bit, but Europe is getting ready to phase in an embargo off of Russian oil. Now, some of that oil Russia will be able to send somewhere else, like India and China, but not all of it. And so we're going to have a disruption in the oil market. And the problem is the oil market, as I mentioned, had started to tighten up. It had started to transition from too much supply, a bust, to too little, a boom. So this has exacerbated the boom. So think of Putin's war on Ukraine as hitting fast forward on a boom cycle that instead of taking 3 or 4 years to complete is going to take 3 or 4 quarters to complete. And I'm afraid to say that oil prices are going to have to keep going higher until we really start to hurt demand. And as I said earlier, it's really hard to hurt demand because people got to drive. Usually the way you do it is through a recession, right? Think about it this way. If you have a job, you're going to buy gasoline to drive to that job. If you're unemployed because of a recession, you don't need to drive so much. You don't have a job. You drive a little bit, you go to the grocery store, but think about it. So in that way, unfortunately, the only way to really stop demand is to slow the economy. It's a sad way that the oil market's balanced. So unfortunately, I think we're headed towards a pullback in oil prices. Now, I think if we get lucky, the recession will be mild. We'll have a soft landing. And then, Saudi Arabia could probably make sure we don't have a disastrous collapse in oil prices. If you think about it, Saudi Arabia's had 2 big challenges since 2014. One was fast growing shale production from the United States. The other was Russia, a big producer that had to be dragged kicking and screaming into OPEC plus. Okay. But Russia's under sanctions and shale oil production has been slowed. I think we're on a slower path. We could talk about that at length if you want, but U.S. producers coming out of a bust are pretty shell-shocked and wary of going gangbusters again. And so I think U.S. shale oil is going to be much more moderate in terms of growth. So if you're Saudi Arabia, your 2 biggest supply competitors are sort of on the sidelines, okay? So that means Saudi Arabia can manage the market a little easier. I think they can probably put in a floor at $90 if we get lucky. If we get unlucky and have a big recession, or OPEC plus can't manage the market, prices will go much lower. Then I think we're going to resume this multi-year boom phase that I think we were heading toward anyway. So in short, that's why oil prices are prone to wild volatility. I've explained what causes that volatility to be reduced, the presence of an effective swing producer. I'm asserting that for the last 20 years, we haven't had an effective swing producer. That's why we've seen the return of these wild Space Mountain boom bust prices. Going forward, I think that we're going to enter a multi-year boom phase, but unfortunately, Mr. Putin probably turned it into a multi-quarter phase. So we may have to have a little bit of a boom bust, a little one before the bigger one. So buckle up, I guess, is my advice. Now, final thing, since we entered the boom bust era about 20 years ago, I've noticed that about every 5 years, a big surprise sort of breaks over the oil market. And this surprise upends how people think about how oil prices are formed and what range they're going to be in and so forth. The last 3 big surprises, each separated by about 5 years, were on the supply side. If you think about 2003 to 2008, when oil prices went from $30 to almost $150 a barrel, what we learned there was that increasing oil supply is really tough. We were surprised, we the consensus were surprised that despite oil prices increasing steadily 20, 30% a year, we weren't getting a real increase in oil production. That just reminds us how steep the non-OPEC, especially supply curve is, or as I said, how difficult it is to increase production quickly. And then if you go 5 years ahead, you get to about 2010, and that's when U.S. shale oil began. The boom began. We had gas before that, but then starting 2010, 11, that's when you had shale oil going gangbusters. Everybody was shocked by that. The United States become this major growing oil producer. And if you go 5 years ahead of that, you get to about 2014, 2015, and that's when we learned that Saudi Arabia, refused to play the swing producer role without Russia alongside. Russia said no, so we had a price war and the price collapsed. So the last three big surprises all occurred on the supply side of the oil market. The first was very bullish. It caused oil prices to go up. The second sort of capped oil prices, and the third caused oil prices to go down. Now, we should all be asking ourselves, what's the next big surprise? In my view, the next big surprise will be on the demand side, not the supply side. Over the last few years, the leading forecasters in the oil market, particularly the International Energy Agency, the IEA, and many others, have over the last few years adopted the view in the forecast that oil demand not only should peak for climate change concerns, but it will. They are forecasting that because of the rapid proliferation of very fuel-efficient gasoline cars and electric vehicles, but mainly fuel-efficient cars this decade, oil demand is going to pretty much decouple from GDP growth in transportation so that total oil demand peaks around 2030. This is the dominant view. I do not share this view. I think this view is more wishful thinking than sound analysis. As my firm analyzes consumer preferences and policies around the world, we see no evidence whatsoever that we're on a track to see peak oil demand by 2030. The EVs are coming, but they're starting from a very low base and not fast enough to move the needle on oil demand. And with regard to fuel-efficient cars, we've seen no real improvement since 2014. And even the IEA has noted during this bust period, the last 7 years, folks are getting into SUVs, not fuel-efficient sedans, around the world, China, Europe, the United States, and elsewhere. So I'm pretty sure the next big surprise is we're going to wake up, we meaning the consensus, and realize to our disappointment, because I think folks are hoping that oil demand would peak, they're going to look around and see the data and realize we're nowhere close to that. We have a lot of pent-up demand since COVID. The electric vehicles aren't spreading fast enough. And we're going to realize, and the data are right there, I'm surprised most folks haven't seen this, that the fuel efficiency of the fleet has not improved enough. And so we're going to see a lot more gasoline and diesel demand than people expect. And when they see that, they're going to quickly connect the dots between that stronger than expected gasoline and diesel demand for transportation this decade to the supply collapse, both refining capacity and upstream, that we talked about earlier during the bust phase. They'll connect the dots and realize that we are in a structurally tight oil market. And that's when we'll really start the multi-year boom cycle.